inherited an IRA. Fantastic. What's better than inheriting money, right? Except that when it's an IRA, there's always a couple of pitfalls, right? You got to pay taxes on that, and the required distributions that are now applicable. We're going to talk in this segment about the latest sort of IRS rules, or how they've morphed them, with our fellow certified financial fiduciary and CPA at Nelson Financial, Kristin Kalley. So welcome back to the program. This course is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, and glad to have back with us Kristin Kalley, a fellow certified financial fiduciary who also happens to be a CPA on the team at Nelson Financial Planning. Good morning. How are you?
Morning. Thank you, Joel, for having me.
Well, good stuff. You always have good stuff to talk about because this tax code is just a constantly ever-changing scheme, if you will.
Mm-hmm. Yep. They got to throw some loopholes in there every couple of years.
Well, and in particular on this one, the IRS has really been all over the place on these distribution rules. So let's back up and sort of set the stage of how we got to this confusion over the course of the past couple of years when it comes to inheriting retirement accounts.
Mm-hmm. So back in 2020, when the Secure Act came out, kind of changed the way we do RMDs for inherited IRAs. So the rules for spousal IRAs did not change, but this is more for if you inherit an IRA and you're a child, a younger sibling, something along those lines. So it used to be that you could take RMDs over your lifetime, but now the Secure Act has said you don't get that same benefit. You now have to liquidate the account within 10 years.
That's a big deal, because previously, if I could take a little bit out along the way, then I obviously would have had that come to me as income and paying tax at a lower bracket than if I'm having to take all of it in a relatively large chunk.
Right.
So, and I guess the confusing part is that the what that 10-year rule means was really up for some interpretation, and then to layer into it, then you had the 2020 year where you didn't have to take required distribution. So what are sort of the rules now, and I guess what are we still waiting on for the IRS to help give some guidance on?
Mm-hmm. So back in 2020 when this came out, we thought that meant you have 10 years to liquidate the account. That you could wait until year 9, year 10, and then take the full balance. And
certainly the language in the Secure Act and some of the things that the IRS said at that time suggested that really was an option, that you didn't have to take, but as long as you took out and had it all out by the end of the 10 years, then that was fine.
Right. But now they're kind of coming back and saying, no, you actually do need to take RMDs in years 1 through 10, and then you do have to liquidate the balance in that final year.
And I guess what was really confusing is that they came out and issued some guidance in February, or maybe it was March of this year, that basically kind of said, hey, wait a minute, we really want folks to be taking out something each and every year. But that really got a lot of backlash against them, didn't it?
Mm-hmm. It just caused a lot of confusion. Nobody had been taking it out, or for the majority of people, they thought they didn't have to, so they might not have been taking it out in 2020, 2021, and then suddenly 2022, they're saying that you should have been doing this all along. So people weren't sure if they needed to go back, do catch-up RMDs. So it did cause a lot of confusion, and there was a lot of pushback.
And so consequently, the IRS said basically, okay, wait a minute, okay, we're going to have to take a step back on this, and so now now we don't know anything. Now we're in the waiting mode, right?
Right. So what we do know is that the IRS is going to have penalty and interest relief for if you did not take your RMD in 2020 and 2021. So there's no need to go back and try to take it. There's relief for those 2 years. And from what we understand, this new rule is going to take place in 2023.
So then going forward, then then if you inherited a retirement account, and again, post 2020, right? Mm-hmm. Because pre 2020, you're sort of grandfathered in.
Right.
under the old rules, which were much more flexible and much more powerful. If you think about required minimum distributions, where it's based upon the age of the beneficiary, if you're a 20-year-old beneficiary or something like that, I mean, you had to basically take like 2% a year out of the account, which then allowed the rest of the account to continue to grow on a tax-deferred basis. So it winds up being very, very powerful, if you're in that situation. But now, post 2020, clearly there's this 10-year rule that basically accelerates the tax implications.
Right. The IRS wants their money. And they realized that a lot of people were starting to defer these RMDs. So now I think that's what striked all this legislation.
Oh, that's interesting. Okay, so a lot of people said, all right, well, then that's fine. If that's the game you're playing, then we're going to play that game and delay and defer. And the folks in Washington are in desperate need of those dollars today.
Sounds like it.
I would imagine, yes. So then, what do we think? And obviously, this doesn't come into play until next year. But what do we think are going to be the rules and the rules going forward when someone inherits a retirement account?
So I think it's going to be kind of the same that we've seen with the RMDs each year, that these inherited IRAs, you're still going to have to take that RMD, which is generally about 3, 4, 5% of the account each year, and then a full liquidation by the final year. So you could split that up. You could kind of wait till the last year there. Not something we generally recommend just because of the huge tax implications. But you'll have a couple options, but you will have to take your RMD each year.
So that's interesting, because it's not like it's a divide by 10 kind of thing, right? Which I think, all things being equal, would be the best advice from a tax perspective, right? Because then that evens it out over the course of the 10-year period of time. So so you would have basically a small required distribution, but then by year 10 you'd have to make sure you take it all out. Interesting. I'm surprised they don't go to just a simple math, like divide by 10. You got to take a tenth of it out. But they're trying to incorporate the normal required minimum distribution rules, I guess, into that.
That's my understanding of it right now. Obviously, more rules could come out, more guidance in the next couple of months.
Yeah. So I mean, in terms of how people should sort of be thinking about it, I mean, obviously there's big tax implications, things like that, that you want to be thinking. And that's why, in the office, when we're having conversations with folks, it's really, the conversations that we're having now are more about, okay, well, what are the tax brackets look intergenerationally between your kids, your grandkids? I mean, what does that picture look like? Because that could drive a little bit as to maybe where you take the money from now in terms of your retirement, or maybe whether you leave the kids or the grandkids or whatever the case may be to be the beneficiaries of these accounts. So that certainly has sort of created almost this intergenerational tax conversation, if you will.
Mm-hmm. Yep. And at least right now, the tax rates are historically pretty low, but they are going to sunset at the end of 2025. So we are going to have some higher rates coming up unless something changes.
Right. And I think the inertia that is Washington would say it's easy to just kind of let all of these wash out, and then we go immediately into much higher tax brackets. I guess that would be sort of a little bit maybe of a silver lining of a tough year in the markets, I suppose. Mm-hmm. How would that perhaps help people this year?
So your income may be lower just because of the market being down. So it might be a good idea to take out some from these inherited IRAs if you don't have any of the market gains like we saw last year. So generally last year we were saying if you don't have to take out of these inherited IRAs, don't, because your income is already higher in that tax year. But this year it's kind of the flip side of things. So it might be a good idea to take some funds out this year when the tax rates are low and you don't have those market gains.
And certainly, it's an interesting concept, because from an investment perspective, I mean, obviously, you don't want to be taking money out when things are down in value. But one of the ways in which you could kind of take real advantage of this is doing something called an in-kind transfer. And we're going to talk a little bit more about that after these messages. So stay tuned with us through the break here on Dollars and Cents. This is Joel Garris and Kristin Kalley of Nelson Financial Planning, talking a little bit about those required distributions on inherited IRAs on the program.